Major banks warn Fed, spike is coming with crash landing. Stack silver now. I say stack silver now because this story is a perfect example of why I got into stacking silver and why I continue to be so bullish on silver. Let's start. This is Reuters telling us that Fed piloting another tricky soft landing. And this article states that the Fed is close to delivering a rare soft landing for the U.S. economy, but it faces yet another fraught challenge, reducing cash in the financial system without disrupting markets. It's not easy, reducing cash without disrupting the markets. The article states, with the Fed having already removed some $1.4 trillion as it shrinks its balance sheets to end pandemic-era support, the focus is increasingly turning to when it should stop. This struggle of quantitative easing and quantitative tightening, this balance that we've been living through, we're all trying to see when it should stop. But that's the landing. That's the tough landing, and trying not to make it into a crash landing. That's exactly where we're at. The article says the worry is if cash in the banking system, called reserves, breach a certain minimum level, markets would freeze up because there's no cash, right? So there's no spending, markets would freeze up. But no one knows what that right level is. The real frightening part about what we are living through here with this quantitative easing, quantitative tightening, is that this has not been done on such a grand level, on such a massive level as where we are today. This is a new territory, right? And that's really the frightening part for everyone. Even people who believe this is going to work, that's the frightening part. And as we experience this and this balancing act continues, I dig my heels in even more. I'm even more confident that swapping my fiat currency out into silver, into gold, into precious metals, this is the smartest thing to do. I'm not a financial advisor. I don't work for a bullion company. I'm just a regular guy that stacks silver, stacks gold, and I'm just telling you my experience and my opinion. Let's keep going. The article says, last week, Fed Chair Powell said policymakers were nearing a decision to slow the pace of quantitative tightening to bring reserves into a nice, easy landing. Powell said they are watching a bunch of different indicators in money markets to tell us when we're getting close. The Fed's focus is comforting Wall Street. Market participants said, even though the task before it is hard, it's difficult because the lines are blurry. The Fed is trying to go from abundant to ample reserves without making them scarce. And market signals to guide it are noisy and are hard to discern. That's when this is done on such a grand level, on such a large playing field, it makes sense that, as this writer states, market signals to guide it are noisy and hard to discern. And the article says, among the indicators the Fed is likely to watch, bank reserves, some key interest rates in money markets, and cash parked in in the Fed's overnight reverse repurchase agreement facility, they said. Now, Mark Cabana from Bank of America's head of U.S. Rate strategy, this guy's from Bank of America, he said it will be quite a feat for the Fed to engineer a soft landing where the Fed leaves the right reserve levels in the banking system. This is like the warning from these big banks saying, watch out. Again, this is Bank of America. He says, it will be quite a feat for the Fed to engineer a soft landing where the Fed leaves the right reserves in the banking system. But he added that he thought they had a decent shot now because they were taking a more accommodative stance. So when we look at this quantitative easing, it involves the central bank buying up securities and assets, buying bills and bonds from the banks. This increases the money supply, right? When we do when we started this quantitative easing, it increases the money supply. The hope is that banks will lend out more money to businesses and consumers. This is why higher money supply is thought to lead to lower interest rates. Money is easier to come across, so it's easier to borrow. But quantitative easing can also decrease interest rates by lowering the yield on financial assets. And that makes Wall Street suddenly perk up, right? The yield is the income return an investor receives. By buying treasury bills, the central bank increases its price by bidding it up, lowering the yield while interest rates remain constant. That's the balance, we went through. That's the balance with quantitative easing. If the government issues $1,000 treasury bills at 2% annual interest rate, and the central bank bids up outstanding treasury bills to 1,100, they can now offer a yield of 1.8%, right, to new investors. The government could introduce new treasury bills that pay $18 annual. That lowers their own cost of borrowing while they spend more. That's the trick. And this could allow for more investment in riskier assets. That's the whole plan. And as we know, quantitative easing can lead to runaway inflation. That's the fear. It can lead to have too much money in circulation. And, we've been living through inflation, right? The dollar becomes less valuable. People like you and I who stack silver, we smell this coming, we live through it, and we turn to silver. But we're not alone. When that happens, when inflation spikes up like that, most people start to turn to tangible assets like this silver round I'm holding in my hand, and they start buying up silver rounds. Even with inflation going as long as it has, it really is a surprise to all of us who've been in this game for a long time. It still is a surprise that silver has remained at its value has remained stagnant for this long. We really thought that silver, even before gold shot up, even before 3 weeks ago when gold had its big jump, everyone was still expecting silver to follow as it's shown in history. Now, I do believe history is going to repeat itself in that when gold shot up past that $1,000 bar back after the financial crisis, when it shot up, it took a little bit, but silver did follow. And I absolutely do see silver following. I still believe that this is a great time to go in and buy as much silver as we can. Again, I'm not a financial advisor. I don't work for a bullion company. I'm just a guy making videos, and I've been stacking silver for years and years. And I see this as a great time to keep going in on silver. I'm still going in on silver. I'm not really buying these silver like reverse proof American Eagles that I'm showing you. I'm not buying these so much because these come with a very heavy premium. I just happen to like them. I like how they look on camera. But silver rounds for sure, absolutely. I'm still going all in on silver rounds, and let's keep going with this article. So the article says that now that central bank is working on quantitative tightening, it is trying to take money out, and this has involved the central bank doing nothing, right? Allowing their debt-based securities to mature. We live in a debt-based economy, right? You buy a house, you don't buy a house using cash. You incur a massive amount of debt. It's a debt-based economy. So when these come due, right, these debt-based securities, when they mature, when they come due, in theory, the borrowers will pay the face value of these loans. But along with this, I almost said crash landing, along with this soft landing that the Fed is trying to perform, we see this, right? We see on top of debt-based securities maturing, we see the issue presently with commercial real estate where loans are coming to mature. And on top of that, these empty buildings are not bringing in any revenue because people are not using the office spaces like they did pre-pandemic. So that is another burden on top of what we're already experiencing. Now, we're living through an economic experiment with this, right? The quantitative tightening has never been demonstrated on the massive level we're experiencing today. It should help inflation as quantitative tightening reduces liquidity because it takes money out of circulation, and therefore it increases it should be increasing the cost of capital, right? That reduces the demand for capital because it's increasing the cost for it. It should also likely increase fixed income yields. Even if the Fed lets its assets mature, bonds can no longer rely on central banks supporting its market demand, right? Because they're pulling out. That's what we're experiencing. They're pulling out. this could allow prices to fall and yields to rise. If rising rates and shrinking demand sound painful, it should. This process should be painful because it's supposed to be no pain, no gain, right? We're supposed to be going through this pain to get the economy back on track. But in 2018, the last time the Fed used quantitative easing, the S&P dropped nearly 18% from its high. You remember that? I mean, that was shocking. So, and also quantitative easing is thought to inflate prices for financial assets in general, right? In addition to the prices of goods and services, it's supposed to, the theory shows that it will inflate prices for financial assets. So Wall Street is very nervous throughout this process, and they're watching very closely as this soft landing that the Fed is trying to perform plays out. But we're going to add to this and really experience over the next coming months the pain of quantitative tightening and the anxiety that comes with it as we try to balance this. We need to also keep a critical eye open as these commercial real estate loans as they come to mature, because that is going to hit on top of this. And again, all the more reason that I swap out my fiat currency and I feel confident in putting my fiat currency into money that I can hold, right? These are silver rounds. I cannot go and buy something with it, but this is money. Silver, gold, and precious metals. If you ask me, in my book, again, I'm just a regular guy, just a silver stacker. I'm not a financial advisor. I'm not a financial analyst. In my experience of years of doing this in my hand, that is absolutely the smart money.